Hello, and thank you for joining me for our next Wealth Building Strategies Workshop, Real Estate and Your Retirement, Part 1. This is Eric Mattingly with DMI Holdings. This series is about self-directed IRA investing. DMI Holdings was founded in 2008. I'm the founder and president of DMI. My partner, Leon Shasteen, is co-owner, and DMI focuses on providing passive investment opportunities for investors to invest in. And we focus on strategic partnerships with quality operators. And currently we've executed on a little over $1.5 billion in investment transactions, totaling a little over 100 private placement offerings. So if you're unfamiliar with investing through a self-directed IRA, it gives you an opportunity to invest in things outside of stocks, bonds, mutual funds. Really, any investment is allowed by law, and you just have to do that through a self-directed IRA custodian. But it gives you control over your retirement. One of the biggest mistakes I see people make is that they just turn their money over to a financial advisor and hope they do a good job. And, sometimes they do, sometimes they don't. But most of the time, the investments are either in low interest-bearing accounts for stability, or they're in volatile investments that can't control whether the market's going up or down. So using a self-directed IRA gives you a lot of options. We'll cover some of those here. So what happens if you invest $500 per month for 30 years? So that's a total of $180,000. Depending upon the consistent return that you get is going to dictate the kind of results that you wind up with. So off of $180,000 invested, if you were able to consistently get a 5% return per year, you would have a little over $400,000. At 6%, it's over $500,000, and so on. And if you can achieve a 10% consistent return on investment, which is very hard to do in the stock market, but not hard to do in real estate and other asset classes, you would have $1.2 million at the end of that same 30 years, just because you were able to get a consistent return. Plus, if it's inside of a retirement plan, you're able to not lose any of those gains to taxation. I know these slides are old, but this is just to give you some further examples. IRA limits are higher right now, but just as you can see, the higher the return you can consistently get, the more you wind up having at the time you're ready to retire. So at a 20% return, $5,000 a year for 25 years, getting a 20% annualized return, on a well-run multifamily project, you can consistently get between 15 to 25%. So these are not unrealistic numbers to achieve. With a small amount of money, you can turn it into a pretty significant retirement portfolio for yourself. As a 401k, you can have higher contributions. Again, I know the slide is old, but again, it's just to show the example of the ability to earn a consistent above market return is the key to really just blowing up your retirement plan. And then with the SEP, obviously, or 401ks, certain 401ks, you can, contribute a substantially more amount each year, and it's going to obviously compound into a larger sum. So right now, there's currently over $35 trillion in retirement plans, and allowing you to self-direct your own retirement plan gives you a lot of options. But all retirement plans by definition are self-directed. The investment options are simply limited by the administrator of the plan. So self-directed retirement plans allow investors to control their retirement funds, invest in any investment allowed by law, and we'll cover those. Combine retirement accounts for investments. So for example, if you're doing a large apartment complex, you're going to have a number of investors, and many of them will use their IRAs and combine their resources together for the purpose of doing a larger investment. There are a few prohibited transactions, but not many. One is life insurance. You can't invest in life insurance inside your IRA, can't invest in S corporations. You can't invest in collectibles, things like cars, art, such as things like that. However, you can invest in precious metals and gold coins and things of that nature. And there's also what's called prohibited parties. So for example, if you're going to fix and flip a home, you're not going to hire your uncle to be the property manager and compensate them. That would be a prohibited party. So your IRA investing should be passive. If you invest in stocks, you don't help run the company. If you invest in mutual funds, you're not the fund manager. It's the same thing with a self-directed IRA. So you treat your self-directed IRA the same way. Stay arm's length from the transaction. And there are certain things you can do, but you want to be careful, as far as compensating people. You can't pay yourself a property management fee if you've invested in a rental property out of your IRA. You would need to hire a third-party property manager that wasn't directly related to you. So, for example, on a fix and flip, don't hire or pay family members. You can oversee the project and, hire in the subcontractors, and anything like that is all fine. But if you are paying a brother or a sister, a family member, compensation from your IRA to help with an investment, that's prohibited. Rental property, don't hire or pay family members, and just use third-party management and you will be fine. And then on a business, if you invest in a private business, don't manage the business, don't work for the business, and don't pay yourself any personal compensation, but you can passively invest in private companies. There is a tax called unrelated business income tax. A lot of people get really carried away and confused about this. It's not something to stress over, but just to go through what it is. And again, it's a little confusing. But to be honest with you, I wouldn't really make your investment decisions based on whether it triggers unrelated business income tax or not. If you've got a good investment and you can get a good return, and even if you did have to pay some unrelated business income tax, then pay the tax. But it's income derived from any unrelated trade a business was originally organized for and originated with the government dealing with tax-exempt organizations. So the case history is very shallow regarding self-directed IRAs. Most passive investments are exempt. Unrelated debt-financed income, UDFI, may cause the income generated to trigger unrelated business income tax. We'll talk about that in a minute. Calculations done on sale and included on the K1. So if your IRA invests and the IRA would receive the K1, and then that's how you would manage your taxes. Every taxpayer situation is different, and you need to consult your own CPA and tax advisor. I'm not a CPA. I'm not a tax advisor. I'm an investor, but we have dealt with these types of things quite a bit. So the difference between the traditional versus the Roth IRA, and there are other retirement plans that you can do as a Roth. So traditional versus Roth. Traditional IRAs and Roth IRAs are mirror images of each other. Traditional IRAs have all disadvantages after retirement, and Roth IRAs have nothing but advantages after retirement. So with traditional retirement plans, here's some of the advantages. The contributions are tax deductible. So if you earn $100,000, you contribute $15,000 to a traditional retirement plan like a 401k, then you're not going to pay tax on that $15,000. It's pre-tax money that goes in. It's asset protected, lawsuits, liens, creditors, judgments, those kinds of things. So there's asset protection feature to it. You get tax deferred growth. However, there are many more disadvantages. So some of the disadvantages are, number one, there's a 10% penalty for early withdrawal. You have to wait until you're 59 and a half to get your money out without penalty. There are required minimum distributions at 70 and a half. They're called RMDs. That just means that if you are not pulling money out once you hit 70 and a half, they're going to require you to take a minimum distribution. So the IRS wants their money. If you don't take your required minimum distribution, it's a 50% penalty. So if you're supposed to distribute, for example, $2,000 to yourself to meet that minimum distribution amount, and you don't do that, you're actually going to get taxed half of that amount, $1,000. Distributions are taxed as ordinary income. So no matter what kind of income goes in, you might have tax advantage income going into the traditional retirement plan, but it comes out as ordinary income. Also, traditional retirement plans affect your Social Security benefit, even if it's not there when you retire. And any withdrawals are taxed as ordinary income. And your heirs, once you pass away, they will graciously get your lifetime legacy taxed at their highest tax bracket. So you spent your whole life, you pass away, or maybe you don't even need the money in your IRA. And when that gets passed on to one of your beneficiaries, they're going to wind up losing a big chunk of your money that you worked hard for at their highest income tax rate. So the IRS at this point has now successfully compounded their retirement plan, not yours. There is what's called a 72T for early retirement distribution. So this is an option for people that may want to start tapping into their retirement plans prior to the age of 59 and a half. You can do that. And it's called a 72T. If you don't want to wait until you're 59 and a half, become disabled or die to retire, then you can set up a 72T, which means that you're going to schedule systematic scheduled withdrawals. You can still hold a job. You can't contribute to the plan once you convert it to a 72T. However, you can continue to invest the money. You can manage the money inside of your retirement plan. You don't have to have a money manager doing that. You can manage the investments that are in there, and you can contribute to another retirement plan. So if you converted, say you had $1 million in your retirement plan and you converted $500,000 over to a 72T and you wanted to start taking distributions out, you can do that. And then you can continue to invest the money, but you can continue contributing to the other plan that has not been converted to a 72T. So the Roth IRA. The Roth IRA is considered the super IRA because it has so many advantages for investors. So here's the disadvantages. Contributions are after tax dollars. So you're not going to get to deduct the money in advance. So it's going to go in after tax dollars go in. Gains have the same 59.5 rule as a traditional IRA. Just the gains do, not your contributions. Here's your advantages. You can access the money after 5 years without penalty, regardless of your age. There are no required minimum distributions because you already paid tax on the money, and the IRS could care less whether you take the money out or not. It doesn't benefit them whether you do or whether you don't. So there is no required minimum distributions on a Roth. You still get the same tax deferred growth. However, when you're taking money out, it does not come out as ordinary income. It comes out tax-free. So there's a huge benefit to a Roth versus a traditional. And it does not affect your Social Security benefit, whereas a traditional IRA income does, because it's taxed as ordinary income. Tax that comes out tax-free does not trigger that. And then when you pass away, your heirs get your entire retirement plan tax-free to them as well. So you can see there are some substantial differences, and a Roth IRA is absolutely the way to go. There are some income thresholds to contribute to one, but you can convert. So what makes more sense to you? Pay tax on this smaller amount. Let's say you contribute $16,500, and over 30 years, you grow that $16,500 into $250,000. Well, I'd rather pay the tax on the $16,500 versus grow that money over time and turn it into a large chunk of money. And now the entire $250,000 is taxable when I want to pull it out. And based on how much I pull out in a year is going to dictate how much tax I pay. So definitely paying tax up front makes a lot more financial sense. So there is a way to convert to a Roth, even if you can't contribute to a Roth. So here's some information with regard to possibly converting part or all of a retirement plan to a Roth. Prior to 2010, if you could not contribute to a Roth, you could not convert to a Roth. In 2010, the laws changed two things. One was anyone at any income level could convert to a Roth. and taxes could be split over 2 years. So in 2010, that is when I converted all the monies that I had in traditional retirement plans into a self-directed Roth IRA. And it was a good opportunity. But prior to that, I was not able to contribute. So here are some mistakes. One is that uneducated investors sell their volatile investments. If you have your money in mutual funds, for example, it might be up, it might be down, you have no control, and you sell those volatile investments, then you convert to a Roth, which does trigger a taxable event for the amount that you convert, or whatever the value is at the time you convert. You pay the taxes due from inside the Roth, reducing their investment capital. So if you did convert to a Roth, you don't have to pay the taxes out of your Roth IRA proceeds. You can pay those with cash. That leaves more money for you to work with inside your retirement plan that you can invest with on a tax-free basis. Then they go right back into more volatile investments and effectively compounding both their tax loss and their investment loss. So I see that happen all the time, and people will, market's down, they sell it, then they convert over to a Roth, they pay the tax from inside the Roth, and then the market drops again, then they panic and they sell, and now they've compounded, 50% loss onto their IRA, which just does not make sense to convert if you're not going to use some strategy behind how you're going to do that. So here are some strategies. If possible, get the investment valued for less than what you invested, then convert to a Roth. Taxes are owed on the value at the time of investment, not the original investment amount. So a mutual fund, cash, whatever the value is at the time, that's the value. However, let's say you purchase a single family home and it's worth $100,000. You bought it for $50,000 and you need to put $20,000 in it to sell it for $100,000. So you could get a broker's opinion of value. So at the time that you bought it, the house is actually in poor condition. You could probably get that valued for $20,000 or $30,000 with a broker's opinion of value. You can provide that to your self-directed IRA custodian. You then transfer the ownership from the traditional IRA of that house to your Roth IRA, and you would only pay tax on the $20,000 or $30,000, even though you invested $50. Then you could put the extra 20 grand in it and sell it for $100. Now you made a $50,000 or a $70,000 investment that was within less than a year liquidated for $100,000. You converted to a Roth, but you only paid tax on that conversion amount instead of on the 100 grand or the 50 grand or the 70 grand, only on 20 or 30 grand, just because you were able to get it valued for less than what you invested. That is a very good strategy, and there's a lot of ways that you can do that with a lot of different types of investments. So only invest in assets that you protect against loss, buy at a discount, or be able to create value, as I just described. So how do you self-direct? With IRAs, you do a transfer. With a 401k, you do a rollover from an old 401k to a IRA, whether it's self-directed or otherwise. Current 401ks, while you're still employed, usually they can't be moved. Only a small percentage. It's called an in-service distribution. So most companies don't allow you to do that unless you're your own employer and you have your own 401k plan. You could actually change those rules, but you would have to change it for anybody who is allowed to contribute to the plan, not just yourself. Sometimes employers will match, and some may allow in-service distributions with their contributions, but not allow those in-service distributions with their matching amounts. There's some rules and regs around all of that, but most of the time when you are employed, you're not going to be able to move your money. With a current 401k, as I was saying, 90% of the employers will not let you roll into another qualified plan while you're still employed there. So let's say you wanted to convert to cash and you wanted to start using that money and you want to start investing in real estate. You don't want to leave your money sitting in stocks, bonds, and mutual funds and the options that they're going to give you in your company-sponsored retirement plan. There is some things you can do. So you can do a 401k loan. Quite frankly, it is best to do this when you're sitting in cash. And the reason is that generally the company will allow you to borrow 50 to 75% of whatever the value is. So if, for example, you were in mutual funds and you had $100,000 and you borrowed 75, and then the value went down, you would wind up getting a call and need to deposit money back in there because it went down below their threshold that they were willing to borrow money. If you're sitting in cash, that can't happen. So that is something to consider, but it would allow you to pull money out. You could go and invest in real estate, flip homes, or whatever you wanted to do at that point, and then you personally financially benefit versus your retirement plan. But it would allow you, if you're a seasoned real estate investor, to go and invest in real estate, use that as a capital source for yourself. It doesn't benefit the IRA, but it allows you to use your retirement plan, your 401k, in the form of a loan. There's what's called self-directed retirement plans that have special purpose LLCs, or sometimes it's called a checkbook IRA. I need to be really careful with this, but I will cover this just because a lot of people are familiar with it. Not a lot of custodians will allow you to have a special purpose LLC, a single member LLC that you're managing, because it's supposed to be, again, arm's length transactions. But this is what it looks like. As we stated before, virtually all retirement plans can be self-directed to avoid investments being tied to the volatility of the stock market. You can set up a single member LLC that can be set up for the IRA to invest in on behalf of the IRA. It allows the investor checkbook control over their own IRA. And now the LLC owns the investments, not the IRA. So the investment for the IRA would be the LLC. The LLC is being managed by you. That there's a lot of controversy because that in itself would, in most cases, be considered a prohibited transaction. Then the IRA owns that LLC, and the LLC then could invest in however many investments that it wanted to. So this is kind of what that looks like. You have a current retirement plan. You transfer or roll over the funds to a self-directed IRA custodian. You don't have to move your whole plan over there. You just move over what you want. But you would transfer or roll over, depending upon the plan. You then want to go and do investments such as real estate, tax liens, private lending, what have you. Any of the income that happens from those transactions would go back to your self-directed IRA, and your self-directed IRA could also manage paying the expenses. So this is just a typical self-directed IRA org chart. You over here are the IRA account holder. You make contributions to the self-directed retirement plan, and then the self-directed IRA custodian would make the distributions back to you. So this is an org chart with the IRA LLC. So again, you have a current retirement plan. You're going to transfer and roll those funds into another retirement plan that's self-directed. You're the account holder, and then you set up an LLC, a checkbook IRA. This is the special purpose LLC. You're the manager of that LLC. The self-directed IRA, you direct the IRA to purchase shares in the IRA LLC. Now you want to do the same alternative investments, and you then are actually managing the LLC, and income goes into the LLC, not to the self-directed IRA. You then would actually write checks to pay any expenses, and this is where it gets a little, sketchy. You could easily be writing a check to your brother for doing services and paying him out of your LLC. The IRA custodian wouldn't see that, but that is a prohibited transaction. That's another reason why a lot of IRA custodians will not allow people to do this, but some still do. You make your contributions not to the LLC, but to the IRA, just like you normally would. And then if you needed to send more money down to that LLC, you would direct the IRA to do that. And then any distributions actually come to you through the IRA, not the LLC. So you do not pay yourself directly out of the LLC. And that's one of the little loopholes where, you're not being compensated and that type of thing, but you are directly involved in managing your IRA. So there's some controversy around that. So with the 401k, you got a 401k. and let's say you have a business, so you can have a self-directed solo 401k. You set up a new self-directed solo 401k, you roll over to that new plan. Your business then makes contributions to your solo 401k, and you make contributions. So that's how you get up to that $46,000 a year or so, just depends upon your age. So you can contribute both from your business and from you, and you can have that self-directed. This allows you to do the investments. The self-directed solo K pays the expenses and receives the income. And then the new solo 401k plan does the distributions to you, not your business. And you have the same ability to do a 401k loan like you do with a major employer. So investing retirement plans together, you can diversify your portfolio, own larger investments and potentially more profitable. And there are some mistakes to watch out for. So here's your top 10 retirement plan, self-directed retirement plan mistakes. Number 10 is not having one. 9 is not starting early enough, not fully contributing to your retirement plan, not listing beneficiaries individually, making poor investment choices, taking unadvised loans. You would want to be very careful what you invested money that you borrowed out of your 401k, because you owe that money back at some point. So if you lost the money because you did some high risk investment, well then, now you owe your retirement plan back, and basically they're going to liquidate whatever cash you have there to pay the loan back. So you don't want to make a bad investment choice when you do take a loan. And then also not rolling over your retirement plans properly. Definitely want to make sure that that's done correctly so you don't trigger any taxable events that you don't necessarily need to. Not understanding any of the hidden fees. Number 2, not choosing the best retirement plan for your current needs. So it depends on what you're going to do, how active you are, if you're passive, active, how much money you're going to hold in there. There's different kinds of self-directed IRA custodians. Some of them are flat fee-based custodians, asset-based custodians, value-based custodians, and there's different ways that they charge fees based on different things. And then failure to realize that it's your money is the number 1 mistake. Again, a lot of people just turn their money over to a money manager and they expect everything to go well and hope for the best with no real strategy in mind. And so this will give you control over your retirement plan. It's your money, and you have the right to invest it in things that and are comfortable with. So there are a few different investment vehicles. You can invest in businesses. So you can invest in a business through your retirement plan. All the income growth and gains are not taxed inside of the plan. Real estate investment options. There's tons of different things you can do in real estate. You can buy and hold, fix and flip, land development, multifamily, seller finance notes, short sales, subject to purchases, assignment of contract. You can buy properties at the auctions, foreclosures, wholesaling, and honestly, the list goes on and on. There's about 21 different strategies to invest in real estate that you can do, and all of those things you can do inside of your IRA. So another thing to do is think like a bank. Loan money from your retirement plan at high interest rates. Use a promissory note, hold collateral that can be sold. All interest and gains go back into your retirement plan, tax-free. And with that, we're going to conclude our Real Estate in Your Retirement Part 1, Self-Directed IRA Investing 101. Love to get an opportunity to connect with you. If you would like to learn more, if you would like access to our investor portal to review investment opportunities, or just have any questions of any kind, please reach out to us. A couple of ways to do that is you can text 66866. Text the word passive, and we'll be able to reach out to you there. Also, you can go to our website, investwithdmi.com, and there's an investor portal section you can request to log in. We also have our main phone number down on the bottom, and you can also email invest@dmi-mgt.com. And with that, I want to thank you for joining me today, and hopefully you were able to learn a few things about self-directed IRA investing.